Hi everyone, welcome back. It's Anthony Allen, your mortgage broker, continuing the first home buyer series, and today I really want to talk about LMI, which is lenders mortgage insurance. So I want to tell you what why LMI is payable first of all. Basically, um, if the banks don't see you having 20% deposit, they are seeing you as a riskier proposition than somebody that has. That's pretty self-explanatory, isn't it? And basically, in order to lend you money greater than lend you a value loan greater than 80% LVR, which is loan to value ratio, then the bank is going to charge you this LMI premium. And this LMI premium, I absolutely categorically want to say initially is this premium does not insure you. Okay, it insures the bank. You are paying for an insurance premium that insures the bank. Whether you agree with it or whether you don't agree with it, if you want to borrow money at higher LVR, this is something that you've just got to pay. And it allows the bank to lend you money at higher LVR. Now, when I say that it insures the bank and it doesn't insure you, if you're going to make your repayments and keep making your repayments and you don't default on your home loan, then no problem whatsoever. Just, and I hope that is the case. But if you find yourself in a situation where you can't make your repayments, the first thing I'd say to you is contact the bank. Contact the bank or contact your broker and make sure they're aware of it, and your situation will be treated much more favorably than it would be than if you just bury your head in the sand and just hope it goes away, sort of thing, because problems aren't going to get resolved like that. But this loan mortgage insurance premium that you have paid is a one-off fee that will be added to your loan at settlement. Basically insures the bank. And if the bank, if you default on your loan and the bank has to sell your property, and say you owe $550,000 on your home loan, and for whatever reason the bank only sells your house for 520, then for the difference the mortgage insurance company would pay out the bank, but then the mortgage insurance company is then going to come and chase you for those monies. So as I said, the mortgage insurance premium that you pay does not insure you. And I'll just go back to my notes that I've made just to absolutely categorically make this clear. This premium ensures that the bank will receive payment from the insurance company if you default on your home loan and the bank is forced to sell your property, and doesn't recover the full amount you owe. It is important to note that this insurance premium does not insure you, and the insurer will then chase you for the outstanding amounts. So I've said that twice and repeated it purely because I absolutely want to make it categorically clear. Okay. Now, I think it would be good at this moment in time to probably just explore some examples of mortgage insurance premiums, because I don't think you would be aware that I'm sure that you're aware just by the this first home buyer series that the bank's policies and criteria are different for every single circumstance, and all the banks will differ. And you would be wrong in thinking that the actual mortgage insurance premium is the same from each bank. And this could vary wildly. So to an extent that you may even choose a lender with a higher interest rate because they've got a lower mortgage insurance premium. And I think in one of the examples that I did earlier, we saw the difference between, I think it was CBA and Bank West or something like that, and the mortgage insurance premium that was applicable at that time. But let's explore that now. So I'm just going to try and share my screen, and hopefully you'll see what I mean. Okay, 1 second, let's have a look. Hopefully you can see this now. So I think we used this example of Mike earlier on in the series, and yeah, I just want to show this to you. So in this particular example, we've got a $600,000 purchase. It's a first home buyer, so there's no mortgage, so there's no stamp duty payable. And in this example, they've taken a loan amount, a base loan amount of around 546,000. Now, 546,000, the mortgage insurance is nearly $22,000, and that's added to the loan. So 545 plus 22 makes a final loan amount of 567,000, which is under the 95%. Now, if I chose a different lender, say for instance, instead of being CBA, and let's have a look at the range of banks. You can see the range of banks that I've got available to me. Let's say we take at the bottom there, Westpac. If you look at the mortgage insurance on the right-hand side in the summary column, it's the fourth number down. You'll see that that number changes to 20,826. So that's a little saving straight away if you went Westpac over CBA. Let's say if we went to NAB, that's a greater saving again. If we went to ANZ, that's a greater saving. If we went to some of the smaller lenders, let's say Heritage, wow, look at that, $15,000. Compare that to CBA, $21,000. So, or $22,000. So that's a saving of $7,000 immediately. So straight away, CBA's rate, they may have a special rate of, even if it was sort of 2% and Heritage's was 2.5%, potentially you'd be better paying that extra 0.5%, because you'd say you would never get that difference back in mortgage insurance premium straight away. So look, that straight away is a good example. As sort of your deposit increases and you get closer to the 90%. So let's say 9.6 is a 540. So let's say the loan amount was 540 instead of 545. Again, you'll see straight away that as soon as you hit 90%, the mortgage insurance premium drops with the likes of some lenders. As soon as you spend more than or borrow more than 90%, say if you borrow another $100 on top of that, then your mortgage insurance shoots up and runs off like a wild banshee. I'll just stop sharing my screen. Look, this is important. This is important to know, and not sure whether all the brokers out there will be doing this. I'm pretty damn certain that banks won't be advising you of this, but you can't just look at your interest rate or your establishment fees or val fees or legal fees and all of that, and your LMI. You can't just take them all in isolation, and you shouldn't. I don't believe that you should just be choosing your loan or lender based on interest rate alone. I mean, obviously, as I've said in earlier First Home Buyer Series videos, that it depends on your situation. You may need to use a particular lender because of their policy, because each policies are different between lenders. But you need to probably look at that last column. You know, what you reap, or, you know, how much is the mortgage insurance? How much is the interest rate? You need to look at the end column of what your actual repayments are. So yeah, wow, what a good video that was, just to basically highlight differences in LMI premiums. Okay, well, look, hope you enjoyed that. Hope you learned, and see you soon. See you in the next session. Bye-bye.